Good everyone, and welcome to another financial modeling and fundamental learning community session. Today we're going to be looking at introduction to the market validation approach with David Mensah.
Hi, sorry
The
to interrupt you. Your screen is not showing. You stop sharing.
oh okay,
Thought you were sharing.
you're sharing.
Okay, now it's showing.
Um,
Okay, so yeah, you can start sharing screen.
All right, good everyone. Today welcome to another financial modeling session. Today we're going to be looking at a quick introduction to the market validation approach with David Mensah. The financial modeling community is being brought to you by UrBizEdge and being sponsored by the Financial Modeling Institution. The Financial Modeling Institution is a respectable accredited institution in the financial modeling. They also offer some courses and certification, and we also have coupons. So you could reach out to us and we could share the coupons for you to take part in the exams. Then your business is a registered Microsoft consulting, financial modeling, business intelligence, data analysis, and enterprise solution firm in Nigeria. We also specialize in helping companies and professionals be on top of their business data. I'm also the developers of the Nigeria Financial Markets Analysis tool on the Microsoft Office store. This is the training for the upcoming training calendar. So you could go on the website and you see the trainings for this week on the website. Then today our guest speaker is Daniel Mensah. And Daniel is a financial analyst with 2 years of experience working with startups in bookkeeping, financial reporting, budgeting, financial planning, and financial modeling. He also served as the teaching and research assistant, and he has co-taught financial related courses and helped gather financial data for preparing financial case studies. He also has had sessions on financial modeling and business validation. He also has a bachelor degree in business administration, and he's also a financial modeling and validation analyst with a certification from the corporate financial institution, and currently is pursuing an associate accountant qualification. So, hello, Daniel.
yes, fine. Yeah, thank you very
Uh,
much. Yeah, for the introduction. And also thank you also for the opportunity to present here. You know, the first time you reached out to me, I thought I didn't have what it takes to kind of come and present here. But I think that was like a year ago. I think, and I think now, I think um, yeah, I can kind of also share the little knowledge that I have in business valuation, especially using the market valuation approach. Okay. Yes. So let me start sharing my screen and let's delve into today's lesson. Um,
okay, yes, I can see your screen.
okay. So my PowerPoint is showing right.
Yeah, Papa is showing.
Okay. All right. So yes, as Ifeanyi rightly said, today's session is on the introduction to the market valuation approach. But I've decided to title it relative valuation because of a quote that I have at the beginning of the presentation. Again, my name is Daniel Mensah, and I work as a financial analyst currently with the Ashesi Venture Incubator, where I help startups basically with financial modeling and then forecasting of their financials. Um, in my financial modeling tasks, I having used market valuation approach a lot. I mostly make use of the DCF. That's the discounted cash flow method in valuation. But I felt like the market valuation approach is widely used by analysts, especially for equity research reports. So I decided to do a little more research on the relative valuation approach, also relying on my lessons from the Corporate Finance Institute, FMVA course on relative valuation, as well as hearing some analysts speak about how they actually do relative valuation on the job, because where I teach, sometimes we have guest lectures come and then talk to us about what they actually do on the job. And the university I teach, which is Ashesi University, is one school that kind of focuses on practicality rather than just the theory. So I believe I've gathered a few things that I can share on this webinar. Okay. So what are we going to look at today? So I'm going to briefly introduce the concept of valuation, and then we'll look at some methods used in valuation, and then I'll dive into relative valuation. We'll look at introduction to relative valuation. We'll look at the advantages and disadvantages of using the relative valuation, and then we'll look at some steps in performing relative valuation, and then I'll talk about some considerations for selecting appropriate valuation multiples to carry out a relative valuation. And then I'll dive into Excel, and then we'll do a small demo, and then we can close off. All right, so I'll start with a quote by Aswat Damodaran, who is a finance professor at the New York University, who is popularly referred to as the Dean of Valuation at NYU. So he says that Einstein was right about relativity, but even he would have a difficult time applying relative valuation in today's stock markets. So, I mean, my take from this quote is that, yes, Einstein was right about relativity because everything is relative, right? Everything is relative. If I say iPhone is expensive, I'm not talking in a vacuum, but it's relative, right? It means it's expensive, or the price is very high as compared to what other mobile devices on the market, right? So everything is relative. I can say this lady here is very pretty, and another person will see her and then be like, oh, she's not all that pretty. Everything is relative. And then Damodaran continues to say that even Einstein, who was very right about relativity, would have a difficult time applying relative valuation in today's stock market. Why? Because today's stock markets are more complex than it used to be. Now you have a firm, you can have a company that trades in multiple countries, and so if you have to value such a firm, it poses more challenges as compared to if you have a firm that trades only in its local borders. So yeah. So, Einstein would actually have a hard time, applying relative valuation in today's stock market. Okay, so let's look at the concept of valuation. What really is valuation? I mean, the term sounds like very technical, but what it basically means is that how much should I pay for this asset? That's all. How much should I really pay for this asset? Should I pay $10? Should I pay $5? Should I pay $20? And an asset in finance can refer to anything, right? Anything that maybe generates cash flows, right? So it could be a bond, it could be a stock, it could be an entire company, right? Or an entire business. That's an finance. So then why do we do valuation? Well, we do valuation for a number of reasons, right? Which includes, but not limited to, selling a business. So if you have a business and you want to sell the business, you really want to know how much is this business worth? How much should I sell the business for, right? And again, it applies to the person buying the business. How much should I really pay for this business, right? So you need to do some valuation to know how worth that business actually is. And then you also do valuation in raising money, right? So this is some of the things that I've done so far in financial modeling is to help startups raise money, right? And then as I mentioned earlier on, I rely mostly on the DCF approach, to kind of help the business owner know that, okay, your business is worth let's say $10 million. And so if you raise funding of $1 million, you should maybe give up ownership of approximately 10 to 15%. Other than that, I mean, it's not worth it, right? So in raising money, you kind of do some valuation. And then IPO is also a form of raising money, but it applies more to latter stages or businesses in the latter stages of their growth, right? So maybe after the business has gone through seed funding, Series A, Series B, Series C, Series E, Series F, and then it now feels like it needs to expand maybe globally beyond its borders. and it needs more funding, then it will undergo an IPO. And again, the market needs to know how much should we pay for this company's share as it's about to go for an IPO. So there needs to be some valuation there. And again, this is what equity research analysts do a lot of the time. Investment recommendation. So you value a business or you value an asset to help your investors or your clients know whether to hold the asset, to sell it, or to buy it. Right. So these are some of the reasons why we perform valuation. So what are some methods that are used in valuation? So I mean, you can mention a lot of what approaches that are used in what business valuation, but all the approaches of valuing a business can be grouped into what into three, right? Can be grouped into three. You see some textbook that will mention income approach, earning capitalization, dividend discount model, DCF, but all of those approaches can be what grouped into what these three approaches, and they are: one, intrinsic valuation. So what really is intrinsic valuation? So you are valuing the asset based on what its own cash flows. How much cash flow can what this asset generate, right? And then its own risk, and then what growth. So with intrinsic valuation, you usually use it for income generating assets. So any assets that can generate what income. So it could be a factory. Once it can generate income, you can use what the intrinsic valuation to value it, right? And what do? You project the expected cash flows from the assets, right? And then you consider what the growth in income, right? Whilst you are projecting the cash flows. That okay, cash flow next year is going to be X, and then cash flow the following year is going to be what 10% higher, which means what there's a 10% growth in what the cash flow in the second year. And then you consider its own risk. So its own risk here is captured by what the cost of what capital that is used in what in the valuation, right? So the cost of capital measures how risky that asset is. So you use the cost of capital to now discount all these cash flows that you've projected, right? So what are some common methods under the intrinsic valuation method? So we have the dividend discount models, where you are now looking at the dividends that you can receive from holding a stock, right? And then you discount all those dividends at what an appropriate cost of capital. Because it's dividends, we might use what cost of equity. And then we also have the discounted cash flow, which is mostly referred to as what the DCF valuation approach, right? It's one of the widely used valuation approaches, and it's one that I use most of the time as well, right? So the discounted cash flow, you kind of project the cash flows that will be available to what the providers of capital, right, of the business, right? And then you discount it at what the cost of capital, right? And then we have the asset-based valuation, where you are valuing the assets based on what you are valuing the assets, or you are valuing a business, right, based on the assets on its balance sheet, right? You are valuing the business based on what its assets on the balance sheet. So you look at the assets on the balance sheet of the business, and then you kind of maybe do a fair valuation for it. So what is the market likely to pay for these assets of the business? So I remember sometime back in 2018, when I was doing my internship with KPMG Ghana, and then they were taxed with a receivership by the Bank of Ghana, and they had to kind of liquidate the insolvent banks in the country, right? And so what they had to do is to bring fair valuers on board to kind of value the assets of the banks. And then there were auctions, and then we had to go, those of us were on the receivership team, we had to go and then be part of the auction. So, and we use the fair value of the asset to kind of serve as a guide in what selling the assets during the auction. And then again, we can also use some of the parts valuation, right? Especially if you have an asset or a business, right, that has several components, right? You can break it down into what its various components, and you value it separately, and now you can put everything together to determine its value. So sometimes the market valuation approach is used during the sum of the parts valuation, right? So you have a very big business like let's say Amazon, and then Amazon is into advertising, is into e-commerce, is into what cloud services and so on, right? So you might want to look at use the market valuation approach to value each of these components of what Amazon, and then bring everything together as one. Yeah, so that's the asset-based valuation. Now, the focus for today is going to be on the last one, which is the market valuation approach, which basically looks at valuing an asset based on how other assets are priced, right? So you look at other assets, how is the market pricing those assets, and you use it as a benchmark or as a basis for pricing your assets. And then the methods include, comparable company analysis, also, simply referred to as comps or comparables. And then, so comparables is what we'll be looking, the focus for today will be on. And then we also have precedent transactions, where if you have some transactions that has happened in the past, a business was sold for X amount in the past, then you say, okay, if the business, if the buyers were willing to pay X amount for this company in the past when revenue was Y amount, then they will be willing to, or they might be willing to pay what Z amount for us, given our revenue of, let's say, W, right? So that's the precedent transactions. All right, so now let's look at the comparable company analysis, which is the focus for today's webinar. Let me see how much time I've consumed. Okay, so the comparable company analysis, right? CCA for short, also referred to as relative valuation or valuation using multiples, right? Basically, like I said earlier, it is what you valuing an asset based on how similar assets are priced, right? So you are valuing a business based on how other businesses that are similar to yours are valued, right? And it's based on the premise that what similar assets should trade at similar multiples. Similar assets should trade at what similar multiples. So, for instance, if the market is willing to pay, 5 times what the earnings, right? So let's say the earnings per share of the company is, let's say, $2, and the market is willing to pay $10 for the share. That means the market is willing to pay 5 times what the earnings, right? It's likely to pay 5 times what for the earnings of what of this company. So we can also assume same thing for our business. If we have earnings per share of 3, then we can see that the market is likely to value us at what $15. So that's basically what the comparable company analysis is about, and that's what we'll look at towards the end of the session. So what are some advantages to performing comparable company analysis? So one is that it's relatively easy to perform. So when you look at the comparable company analysis, it's more easier, right? Relatively easier to perform as compared to the DCF approach, for instance. Because for the DCF approach, you have to make several assumptions. You have to project the financial statement of the business into the next 5 years or the next 10 years, and then you have to now calculate some appropriate discount rates that you use, and then you now come and discount all those cash flows to find the value of the firm. But then the comparable company analysis is, it's relatively easier, right? You don't really need to make so many assumptions as compared to the DCF. So we say it is what relatively easier. And then it's also based on publicly available information, as opposed to like the intrinsic value, such as the DCF, which relies heavily on a lot of assumptions. For the CCA, you have a lot of available information that you are relying on. You have a lot of market information that you are relying on, right? So you are more likely to be right than when you are using the intrinsic value, because your assumptions may be wrong, and then it throws your valuation off guard, right? Then the last advantage is that most likely there will be a lot of companies that are listed, and then you have their information to use for the analysis. But here's the downside: when there are few companies, or there are no publicly traded companies that are similar to yours, it becomes difficult to use the comparable company analysis, right? And then also the other downside is that there are no perfect comparables. No two businesses are the same, right? So you may have two businesses that are similar in size, but guess what? They might be different based on maybe strategy or maybe one might be more riskier than the other, right? And then you can also have two businesses that are in the same industry, but one might be bigger than the other, and so on and so forth. So there are no such thing as perfect comparables. And then finally, it's difficult to adjust for qualitative factors. So you things like what the strength of management, right? It's a qualitative factor, and when you are doing CCA, it's difficult to adjust for something like that, right? But when you are doing intrinsic valuation such as the DCF, you can kind of push up the cost of capital slightly if you notice that management, the company has a weak management team, right? So it's slightly more difficult to adjust for qualitative factors when you are doing comparable company. Okay, so what are some steps in performing a comparable company analysis? So the first step is to understand the business. Now, any company or any asset that you have to value, right? Regardless of the approach that you use in valuation, you need to be able to understand the business very well. You need to understand the nature of the business's operations. So what is the business really into, right? You need to understand the nature of the operations. You need to know the industry that they belong to. Now,
then I have a question. Okay, so what if there's no business that is similar to the business like it's new? So what would you not do?
Okay, so okay, very good question. So you want to use the comparable company analysis, right? Yes. But then there's no business that is similar to yours. Okay, so here's the thing. One is so I was just about to talk about the industry classification of the business. So sometimes if you narrow the industry classification of of the business too much, you might have very few companies to work with. For instance, I can classify Amazon as maybe an e-commerce business. And if I say it's an e-commerce business, then it means that I have to only look at other publicly traded e-commerce businesses. But once I don't find, let's say, publicly traded e-commerce businesses, maybe I can widen my scope of my industry definition and say, okay, I'm looking at tech companies. And so I can bring in Facebook, I can bring in Google, I can bring in, Amazon, I can bring in other, tech companies, because I feel like they may be exposed to the same kind of risk. So I can kind of classify them as as comparables. I don't know if that kind of answers you. So
yeah, that answers.
Okay.
Thank you.
Okay, welcome. And again also, if for instance you are valuing a business, and then so people that work in investment banking, right? So I don't work in investment banking. I call myself a roadside analyst, because I mean I don't work in a typical big investment bank where you have access to all of these Capital IQ and Bloomberg. That kind of helps you to easily get access to market information. And so if it's difficult to really find to find comparable companies, then you can rely more on the intrinsic valuation for your business. Yes, but again, it depends on how wide you are kind of defining your comparable groups or your peer groups. Okay, so again, so I believe by the time we are done with we'll also look at building the list of the comparable companies, which is the third step, and then that will kind of also throw a bit more light on your question, if I. So we also look at the risk profile. So how risky is this company, right? And the kind of risk that the business is exposed to sometimes depends on the countries in which the business does operations. So you have Coca-Cola that's sells in Ghana, sells in a lot other countries aside just the US, right? So Coca-Cola will be exposed to more risk than a company that just operates, let's say, in the US, right? So you kind of have to consider the risk that the company is also exposed to. Okay, so the next thing is to select appropriate valuation multiples. Now, there are lots of valuation multiples that you can use in your valuation, but do you just get up and then choose any and then use them? Not really. Some multiples are more appropriate for some industries, and then are also more appropriate for some businesses at certain stages of what their growth cycle. So we'll look at some considerations when selecting the appropriate valuation multiples. So now the third thing is to build a list of comparable companies. So like I mentioned earlier on, building the list of the comparable companies, you have to define the industry. So the industry, based on how you define it, you may have a lot of comparables or you may have very few comparables, right? So I can say I'm looking at, let's say, beverage companies. And if I'm looking at beverage companies, then I have to kind of limit my comparable list to what? Only beverage companies. But I may realize that, okay, beverage companies might not be a lot, or there'll be a limited number, or none that is listed on the stock exchange at all. So I may open it up a bit and say food business, and then I'll kind of use them to do my analysis. And then we have size, right? So the businesses that you are considering in your comparable company analysis needs to be of similar size, right? Now, size can be based on the number of factors. You can look at the revenue of what the business. So you can look at companies that their revenues are in a particular range, right? They are close to each other. So let's say you are looking at 1 billion to 2 billion in revenue, right? That can be how you are defining your size, right? And it's a bit of it involves a bit of subjectivity as well, right? That's why they say that valuation is more of an art than it is of a science, right? So you have to kind of apply some judgments here. So size also, you can look at the market capitalization of the business, right? So what is the total market capitalization, which is basically the number of shares of the company times its share price, right? Again, you can look at the assets of the company, book value of equity, and the rest, right? But it also depends on the type of business and the industry. Financial institutions or leverage businesses largely, their value drivers are based on their balance sheet, right? So when you are looking at such companies, you can compare them based on what the size of what their equity, right? Because sometimes due to regulations, they might need to maintain certain levels of equity and all of that. And then you can also consider the market cap for the leverage businesses. Okay, then we also have geography, which is where the business is located, right? Which is where the business is located. So it's very good to have businesses that are located in the same country. So if I'm, let's say, performing a valuation for MTN Ghana using comparable company analysis, I might want to look at what other telecommunications in Ghana are listed on the Ghana Stock Exchange, right? That will be my starting point. But if I don't find any, then I can widen my scope a bit and say, okay, let me look at West Africa. Do I find a lot of telcos that are listed in West Africa? If I don't, I can widen my scope and say, okay, let me look at Africa. And then sometimes too, it becomes difficult to even find similar companies, maybe even in Africa. So sometimes some analysts look at emerging markets, right? India and the rest, right? And then they look at similar companies that might be similar to the ones that they are trying to value, and then they use them as well. Comparables. Then, also, of course, you also need to consider the risk, as I mentioned earlier, and then profitability and growth, right? So you need to look at businesses that are similar in terms of their profitability and then also their growth, because the higher the profitability and their growth, the more likely the market is willing to pay for higher share prices for the company. Okay. So the next step is to gather financial data. So in gathering financial data, you kind of you have to look at the annual reports of the companies, in the list of comparables that you've compiled, right? And then you also use stock market information by looking at what is the current stock prices of the companies and so on. Yeah. Yeah.
Isaac, just a question.
Okay. Okay. Please go ahead. Sorry.
So can you?
Hello. Hello.
I think you can go on.
I should proceed. Okay.
Daniel.
Okay.
Let's go.
Okay. 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 So after you've gathered, the financial data, you kind of set up a comps table, right? So you set up a comparable company analysis table that you use in, computing your multiples that you then use for your valuation. And then the last step is to adjust for any differences that there may be, and then what you apply the multiple. Now, adjusting for the differences may be based on a number of reasons. One is maybe you are trying to value a company that is not listed, which is a private company, and then you are using listed companies as what the list of comparables to do the valuation, right? Because of marketability or what we call liquidity issues, right? That the private business, people will be willing to pay a lower amount for it as compared to a publicly traded company, because what for the private business, it will be difficult to kind of sell your shares once you have a share in that company. And so sometimes analysts will apply some discounts to the multiples that they've gotten from building the comps table before applying it for the valuation. And sometimes the discounts may be on the order of 20 to 30%, right? Depending on the analyst and then depending on the business that is being valued. Okay, and then also adjusting for the differences. Sometimes it's very difficult to find companies that are very similar in terms of size, especially or maybe in terms of even geography or risk. And so what you sometimes do is that you kind of do what we call multiple linear regression, to kind of take out the noise, right? And by noise we mean the factors that can cause the market to price one asset higher than the other, even though they might look very similar. So what am I saying? For example, bigger companies, are less riskier, right? Are viewed as less riskier, and so the market will be more willing to pay higher prices for it, for their shares, right? And then some companies might also have higher growth than others, and some companies might be more riskier, and so have a higher cost of capital than the others. So you kind of do some multiple linear regression to kind of reduce all of those noise, so that you can have clean multiples to then use to value your company. All right. So what are the steps in selecting appropriate valuation multiples? What are the steps in selecting appropriate valuation multiples? So before we delve into actually choosing the multiples, we need to look at the definition of the multiples, right? We need to look at the definition of the multiples. So first of all, we have enterprise value multiples, and then secondly, we have what? Equity value multiples, right? So what is enterprise value in the first place? So enterprise value is the value of the firm to both equity and debt holders, right? So the value of the firm to both what? Equity and debt holders. So because you are looking at the value of the firm, as that the value of the firm to both debt and equity holders, when you are picking a financial metric, and we'll kind of look at right? If you are picking a financial metric, you pick a metric that comes before interest. Now, here's the whole thing about the relative valuation. So you kind of pick how the market is pricing the assets right now, right? And then you divide that by what? By some financial number on your financial statement. So you say, okay, the market is valuing this entire business, 5 times what? Its revenue, right? So when you are picking that number from the financial statement, once you are looking at enterprise value multiples, that number should be before interest expense has been deducted. So what am I saying? If you pick revenue, or sales is way before what interest expense, right? EBITDA also is before interest expense. Interest expense hasn't been deducted yet. Also EBIT, and then free cash flow, free cash flow to firm, right? And also capital employed, right? So these are some common enterprise value multiples. And the rule of thumb is that there should be consistency in the multiples that you are choosing. It wouldn't make sense to now pick let's say EBITDA and then use the numerator as what? Price, and say price to EBITDA multiple. So the rule of thumb is that there should be consistency. If you are using an enterprise value multiple, the financial metric should be before interest expense has been deducted. But if you are using an equity value multiple, so equity value multiple, you are looking at the value of the firm to only equity holders. And so the financial number that you pick from the face of the financials should be after interest expense has been deducted. So, for example, you can look at the price to earnings ratio, you can look at the price to book, and you can look at the price to cash flow, where cash flow is what? Cash flow from operations or operating cash flow. Okay. All right. So I think, yes, we are about to wrap up with the selection of the multiples, and then we can delve into Excel and do some demo. So when is a multiple appropriate? When is a multiple appropriate? So like I said, multiples are appropriate, or the appropriateness of a multiple would depend on things like what? The stage in which the stage of the growth cycle that the business is in, as well as what the industry that the business is in, right? So usually early stage companies, right? And here's the thing: it wouldn't make sense, right? It wouldn't make sense for you to use a multiple that is negative to do your valuation, or even use a financial metric that is negative to do your valuation. What am I trying to say? If your earnings or your earnings per share is negative, it means you can't use the PE multiple in your valuation. If your EBITDA is negative, it means you can't use enterprise value to EBITDA for your valuation, right? And so, depending on the stage in which the company belongs to, right? If the company is at the very early stage where it has negative profit, EBITDA is negative, EBIT is negative, profit is negative, and cash flow from operations are all negative, right? If you want to use the market valuation approach, the best this thing to use would be what? The enterprise value to sales, right? And then again, when the business is growing, at a point EBITDA becomes positive, right? And so at that point you may use what? EBITDA for your valuation, right? And then if the business becomes more matured and then growth is slowing down, and then they have a positive EBIT, right? Then you can also use the EBIT for it, for the valuation. And then we have the PE multiples. So PE multiples are mostly used for more matured companies with stable earnings. So the company is at the stage where it is very matured, and then profit is not really growing. It's mostly around the same number, right? So typical example, if we had to pick a company in Ghana, will be a company like Standard Chartered Bank, because it's very matured, and then earnings is quite also stable. But then sometimes some normalization might be needed, because there might be some one-off items that has been included in your net income that might need to be taken off. Hopefully, I might want to come again and talk about normalization of financial statements, which is a new thing that I've learned, from D. Brown Consulting, and I've started applying in my financial modeling. So hopefully, one of these days, I'll come and talk about normalization if I'm permitted. I just pray.
Yes, you are. Yes.
Okay. To book. Okay, thank you. Fine. Okay, and then you also have the price to book. The price to book ratio. The price to book ratio is mostly used for leverage businesses such as banks and insurance companies, because for them, their value drivers is actually on their balance sheet, and because they are highly regulated, most of the time you can't have their book value of equity being negative, and so banks, you typically apply price to book. But again, I've also seen some equity equity research reports that made use of price to book, both price to book and then price to earnings, which is the PE for banks, right? So I mean, PE can also be used for banks, but then you don't want to use you don't want to even use enterprise value multiples, right? You don't want to use enterprise value multiples for valuing financial institutions, because they are leveraged businesses, and it's difficult to differentiate between what their actual borrowings are, right? Sometimes they do disclose it, but it's difficult to. There's a thin line between the interest that is is based on their borrowings versus the interest that they are paying based on deposits. Sometimes they just put everything together. So you don't want to use what enterprise value multiples to do what to value leverage businesses or financial institutions. All right, so here's the exciting part. So now we're going to delve into Excel, and then we will look at how to perform the comparable company analysis in Excel. So here is what I've done. This is so, I mean, I like to work with, telecommunications. So here I want to do a comparable company analysis for MTN Ghana, right? Now, this is what motivated me to pick MTN Ghana for this analysis. When MTN went public, my faculty and I, we were doing a case study around MTN, and so then we kind of did other valuation approaches, and then when it came to the market valuation approach, so I kind of gathered data and then used it to perform the analysis. And here's what I noticed: there at that time, and even as at now, there isn't any telecommunication that is listed on the Ghana Stock Exchange. And so here's what I'm doing. So I pick companies that are other telcos in other African countries, right? So you can see my. Is someone speaking, please? Looks like someone is speaking, but it's breaking.
No, no one. Okay, no one. You can't speak.
Hello?
Yeah, hello. You can speak. You can speak. No one is speaking.
Oh, someone speaking, please. I can hardly hear. The person is breaking up.
No, no one is speaking. No one is speaking.
Oh, okay. Okay.
No one is speaking.
Okay. All right. So this is what I did. So I picked other comparable companies that are listed in other African countries. So I picked MTN Nigeria, Telecom in Egypt, MTN in Uganda, and then I also included MTN Ghana in the peer group, as well as Safaricom in Kenya. So here's the thing. So because I wanted to kind of watch how close they are in terms of size, right? I converted everything into dollars. So initially, their original data is here in their local currency units. So I have their share price in their various local currency units, and then their market data, which is their debt and cash, and then their financial data in their local currency units. But doing this will be difficult to kind of check whether the firms are similar in sizes or not. So then I put some exchange rates here to kind of convert everything back into dollars. So now looking at my sales, I can see that this peer group is quite okay, with the exception of what MTN Uganda, right? Because if I'm to look at revenue is within a certain range, and so I can say that they are quite similar in size, right? Except MTN Uganda. Now, sometimes here is what analysts do to kind of control for some of these differences, right? You may pick out this MTN and exclude it from your analysis because it doesn't meet the definition of what that peer group. If you are to define revenue, if you are to define the peer group as revenue between $1 million and $4 million, right? Or actually, this is in trillion, right? This is in trillions because everything here is is in millions except the per share price, and so it means that these figures here will be in trillions. So I can exclude this, or if it's difficult to find comparable companies such that if I exclude it, it will make me have very few comparables to compare to. Then I'll kind of then do my multiple linear regression to kind of take out what the noise, right? So now let's look at let's look at how to fill out the comps table. So here is what I did. So you pick the current share price from their various stock markets, and then you pick the number of shares outstanding, and the rest of the things from their financial statements. Now let me talk a bit about each of these things. So the shares outstanding, right? So usually you have basic shares outstanding. You can also have weighted, average shares outstanding. You can also have diluted shares outstanding. Right? Now, in performing comparable company analysis, it is the diluted shares outstanding that you make use of, the diluted shares outstanding. But here's the thing. Sometimes it's difficult. Sometimes you don't even find the diluted shares outstanding in the financial statement. But here's what sometimes I do. So you can work backwards because you might have your net income, and then you also have your diluted earnings per share, right? So if you work backwards, you can kind of get what your diluted shares outstanding, right? But sometimes also you can, yeah, I think that would be beyond the scope of this session. But yes, shares outstanding will be what based on the diluted shares outstanding. Now, let me be working as we go. So I'll take my share price and multiply it by what my shares outstanding to give me what my market capitalization. Let me pull this down so I can see that what my market cap is within a certain range, but MTN Nigeria and then Safaricom Kenya are kind of some outliers, right? So sometimes if you want to keep them in your comparables, you kind of for the noise with the multiple linear. Okay, so now we have total debt. So what is total debt? So total debt will include all your interest-bearing liabilities. So all the liabilities of the business that the business will kind of have to pay interest on. So it will be short-term debt, long-term debt, current portion of long-term debt, leases as well, because lease also have what interest components, right? So both the current portion and the long-term portion of the leases all together, you include it in what your total debt. And then you have your cash and equivalents, right? Cash and equivalents, right? You kind of also put them here, which you find directly on the face of the financials, actually, the cash and equivalent. So now we need to find what we call net debt. So net debt is, we are assuming, the assumption is that, once the company is acquired, right, the acquirer can use the cash that the business has right now to reduce some of the debt that the business has. So we kind of sometimes net cash from what, the total debts, and we have what we call net debt, right? We have net debt, and then now we have what enterprise value, right? So enterprise value. So the enterprise value is simply what the value of all your shares, right? Plus what the net debt, right? Plus the net debt. So you find your enterprise value, right? Now I'll pick my financial data. Now here's the thing. So the financial data also, we sometimes, there's a saying that valuation is, is based on future performance rather than past performance, right? It's based on future performance rather than past performance. So most of the time, when you are doing, market valuation or relative valuation, the financial data that you pick, which is sales, EBIT, earnings, whichever one you want to pick, especially the ones that are on the income statement, right? You have to base on what the forecasted ones for the next year. So we are in 2022, so you can look at what analysts are forecasting for what 2023, right? 2023. But then if you don't have such information, because maybe you don't have access to the tools that analysts use, such as Capital IQ, you can also use Market Screener to kind of get estimate of what some of these numbers for the next year. But it's not every company that is there. For instance, the companies that I have here, not all of them can be found on Market Screener, so it becomes a bit difficult to kind of use. So what I relied on was to use the current financial data. So you can have trailing multiples, you can have forward multiples, and then you can also have current multiples. So current one is based on what the current financials of the business, right? So the current financials of the business. So you look at what is the just ended published financial statement for the business, right? And then you kind of make use of that, especially the annual report, right? And around this time, a lot of companies have released the annual report not long ago for 2021. So that's why I'm making use of the current, right? You can also use the forward, which is the estimated for, let's say, the next year. And then we have the trailing, right? Sorry, I think, yes, the trailing, or also known as what? yeah, I think also known as last 12 months. So for this one, you kind of look at what the financials of the business is for the last 12 months. So you have to do some addition and subtraction, which I think we don't have the time to talk about. Yeah, you have to do some addition and subtraction to kind of arrive at that. So now let me quickly kind of compute my multiples. So I'm going to try to work a bit fast here. So my EV to sales, I'm going to take my enterprise value. So all my EV or enterprise value multiples, I'll take my enterprise value and divide by the appropriate financial metric. So here's what I'm going to do. I'm going to keep my column constant. Yep, and then times what? The sales. Okay, so oops, actually divided, right? Yeah, so it's enterprise value divided by that, right? So let me just drag it. So it means I've done the EV to sales for all the companies, and because of my absolute or my referencing, when I drag to here, I've kind of calculated for this one and then also for this one as well, right? But for PE is different, right? Now PE is saying price per share over earnings per share. So I can take my price per share, have earnings per share, I will use it to divide. But earnings per share, calculation can sometimes be, some way, right? So you can use the earnings instead, which is the net income, right? On or profit after tax, right? On your financial statement. So you take your right. So since you are going to use the total earnings, you have to use the market capitalization. Then you divide it by what? The earnings, right? Market capitalization divided by the earnings. All right. Now, having done this, now I kind of have to find what the median and the average for these, right? So the median and then the average, right? So let me find my average. So I'll use my average function, right? And then I also use my median function to kind of do this. Okay, so these are the multiples that I'm going to use for my evaluation. I think I'm running out of time, so let me quickly try and then wrap up. So these are the multiples I'm using for my evaluation. Now we have the average and then we have the median. Now, according to statistics, right? According to statistics, these multiples, you can have some of them close to zero, and then the highest number can be anything, right? So here you can see 16.4, right? During the MTN case study time, I saw one company having a multiple of about 54, right? That was very, very high. So for multiples, it can range from close to zero all the way to what you can have, right? And so according to statistics, when the data is skewed like that, you make use more of the median, or you rely more on the median, because the average will be affected by what? The outliers, right? So now here's the thing. So down here, I'm now coming to perform my evaluation of MTN, right? So I've kind of computed the multiples, and then I'm going to use it to do my evaluation. So here I have the assumptions that I will need to value the MTN. So I share their total debt, their cash, and then what? And then I've calculated the net debt as what? Total debt minus cash that we did earlier on here, right? And then I also have financial data here, which is basically all this data that I was using for the other comparables, or to find the multiples, right? So what I'll do here is I have the metric, then I'll put the metrics here, and then I'll bring down the multiple, and I'm going to use the median, right? First way I can do this is to just transpose, right? So let me just transpose. Let me highlight all these things and then transpose just to save time. Okay, so I've picked all the multiples down here. Now what I'm going to do is to now use these multiples to kind of value the company, right? Now these are enterprise value multiples, so I'm going to pick these multiples, right, and then use them to what? Multiply what the relevant financial data. So I have this will be what? This times what? Revenue, right? And I know that they are in order, which means that for EBITDA is second, EV to EBIT, this one is also there. So I'll just drag it down, just kind of fill it out, right? So these are the enterprise values I'm getting. Now let me leave the last one and kind of find the share price here and then come back to this one. So my market capitalization, therefore, is going to be what? My enterprise value, right? My enterprise value, right? And then I'll take away what? My net debt, because we are saying the value of the firm that belongs to shareholders is the entire firm minus what belongs to what? Debt holders, right? So I'm going to pick my net debt here. And again, I can just, lock in my net debt here, just so that when I drag down, it will kind of bring it down. I'll remove this one. Right. I'm doing this to save time, right? So then the share price will then be what? My market capitalization divided by what? My shares outstanding. Again, I'm going to log this and then bring this down, right? And then finally, I have what? My PE. My PE, this is what the PE is. The PE is what? Is the market capitalization, right? We calculated it as the market capitalization divided by the earnings, right? So it means that here I'll find the market capitalization first, right? Before I can find enterprise value. So I'm going to take what? My PE and multiply it by what? My earnings. Then it gives me my market capitalization. Again, because of what referencing, I can drag this down and then it gives me my share price based on what? The PE. And then here, this one will just be what? Enterprise value here will be what? Market capitalization plus what? The net debt. So this becomes like some sort of range of what share prices for me that I can kind of use to set what a price target for what these shares. But remember that these share prices are in dollars, right? So I can kind of now have share price in cedis, right? In Ghana cedis. Let me kind of okay. So yeah, quickly let me convert this. Then I have my exchange rate here, right? So my current exchange rate for the CDs is 7 points this. So that's this. Let me just log this in. And it kind of gives me this, right? But when you look at this, and you compare it to the current share price of MTN, which in Ghana cedis now is 0.9, it might tell you that MTN is way undervalued. But then again, because of things like the noise, right, that we sometimes have to control for, before applying the multiples. Other than that, you might arrive at what some wrong valuation conclusions. I think my time is up. I didn't manage my time very well, so maybe I have to pause here.
Oh no, if you are stay off, you can stay finish up the calculation. I need any questions. Anybody could ask if there are any questions so far. But if you have not done, you can still continue.
Oh, okay. So in terms of yeah, thank you, fine. So in terms of controlling for the noise, right? Let me just do a shabby work here, and then I can just close off, because these are that actual numbers. So I just kind of assume them and put them here, right? But then controlling for the noise, we know, so how do you call it? Choosing, perfectly comparable companies, right? We spoke about size, right? So we spoke about size can impact what we are doing, right? And size can be based on what? It can be based on the market cap, for instance, right? So market capitalization, for instance, it can be based on the revenue, and so on, right? And then we also have risk. Risk can be based on what? We can use what? The standard deviation of the company's stocks, right? Because that kind of tells us or gives us an idea of what? Of the risk. And then we can also have growth. So we can have what is the growth in the company's earnings, right? If it's a forward PE, then we can look the expected, we can use the expected what? Growth. But if it's what? Current PE, then we can use what? The current growth, right? So, and then we also have profitability profile. So profitability profile, we can have we may use what something like return on equity as a profitability as a proxy for profitability, right? So once we've calculated for these for what the company, so now I'm trying to kind of see how these factors here, which is what size. So I think I didn't have market. I didn't have anything relating to size here, right? And then we can look at size, and then the risk, and then we also have what growth, right? Now, what we are trying to, so we have to pick each of the multiples. So we are picking this one. So the first one that we are dealing with here, I think this one is the EV to, where is it? Okay, this is the P. This is the P ratio, right? This is the P ratio. Okay, so the P ratio, that's why I brought in profitability here, return on equity, right? So you can then do a multiple linear regression. So let me see. So you have the data. So you go to data, and then you go to data analysis, and then you go to regression. So here's what you do. So you are looking at this one, right? The multiple, and then how they are explained by these various factors, right? And then, yes, I'm including labels, so I put in labels here. And then once I do this, and I kind of see, how my multiples are being affected by what the various factors, right? So I can see that growth, this is how much growth impacts what my multiple. But then I'll look at my p-values and see which of them are statistically significant, right? And looking at this, if you had to compare it to a 0.05, which is what we mostly do, I think, for social sciences, right? I don't know if finance is included in social science, but I guess so. If you are using 5%, then it means that what is only growth that will be what statistically significant, right? So we will kind of use this together with the growth to kind of explain, the multiple for MTN, right? So we will have, let's say, right, so let's say we have P P for MTN. Yeah, we kind of have this is, and then we use this to, let's multiply this by the growth of MTN. So it kind of gives us what, it kind of tells us that, so let me change this to a multiple. It kind of tells us that MTN should trade at what, 4.7 times its what earnings per share, right? And so it tells us that even the current trading multiple, which is 4.4, doesn't undervalue MTN so much, because looking at the factors that we have here for MTN, which mostly is explained by growth for the price, for the PE ratio, right? It's mostly explained by growth. It means looking at the growth of MTN shouldn't really fetch so much of a high valuation. And so I think the 4.4 is not so much of an undervaluation for MTN. And so for PE, we can use this, to then value MTN, if we are to take out the noise instead of this 11.8 that we have. So I think that's how we control for noise when we realize that the companies are not so perfectly comparable. Based on some of these factors like growth, profitability, size, and then risk profile. Yeah, so I think that's it. Thank you.
So thank you so much for this session. I personally know I learned a lot during this session. There any questions? No. I think there are no questions. When there's sort of every questions, usually ask our guests to this then 2 questions. So the first question I usually ask them is, The first question I usually ask them is, so how did you get started in like financial modeling and the whole validation stuff? How did you get started? Like,
Sorry, fine. Please come again.
so the first question is like, how did you get started? So with financial modeling, with the whole finance space, like, how did you get started? Like, what inspired you to, I guess, to pick it up?
Okay, I think that's a very interesting question. Because I consider myself as a young person and also very young in the field of finance. But my whole finance journey got started. I think from high school, I kind of liked accounting. And so when I went to university and I studied business administration, I also enjoyed accounting. It was general management as opposed to business administration with focus in, let's say, finance or accounting. But I think I enjoyed my accounting and finance classes. I loved working in Excel. In my third year, there was a financial modeling competition that was organized by our one of our top finance lecturers in the school. And then it started with I think about 10 hours of training in Excel and modeling basics. And then since I enjoyed working in Excel, I worked hard, or I put in effort to make sure that. So I take the first place in that competition in 2019, and that kind of thank you, and that kind of piqued my interest in financial modeling, in finance, and everything. So immediately I started looking for financial modeling courses online, and I came across CFI, which met my budget at the time. So I decided to enroll, and then I was doing it whilst still schooling. And then after that, I've applied myself to learning from courses, a lot of courses online in financial modeling. I've attended a number of boot camps. I've been here. I've attended UrBizEdge, sessions before. I've also watched some videos of UrBizEdge on YouTube. So basically, I would say like my whole journey has been a lot of learning, and then trying to apply what I learn, to the spaces that I work. So, and I was fortunate also to kind of, be engaged by the Ashesi Venture Incubator, where I basically build financial models for startups, and I kind of also hold sessions for them in terms of financial projections and also bookkeeping and the rest. So, and alongside, I've also been doing part time, which is more or less like a finance. So I also worked as an account assistant, which was a volunteer role for about 3 years. And then I currently work as a finance officer with one organization in Zimbabwe. Then I've also been teaching alongside. So, I mean, all of these experiences, I think, kind of has, kind of broadened my understanding a bit of the field of finance. And I'm still learning. So I'm still learning. Yeah, thank you.
What advice will you give to maybe if someone wants to start? Do you have what advice will you give them to for those who want to start? Someone that wants to start out, maybe finance.
Okay, I think that's a very good one. So I would say that it all starts with a bent to really learn and become better. I think that's one thing that has really driven me a lot. So if you look at my LinkedIn, you see that I've taken so many courses, because like there's always that desire to become better at finance. And so I think it starts there, and I think it also starts with some of these webinars really help a lot, because I attended the Brown's financial modeling webinar like a number of years back, and during that time, my knowledge of financial modeling was almost zero. So I was just there, talking about project finance, and I didn't understand anything. But I kept going and going and going, and thanks to the team at the Brown, think now, I can, I'm quite confident in my modeling skills. Other than that, I wouldn't be here. So yes, I think it's a lot of learning, and yes, so I think determination and learning. Yeah, that's what I'll say.
Okay. Thank you so much for accepting, and thank you for the session. I learned a lot about the validation space. So maybe we'll see you one time again for another session if you come again.
Yeah, I'll be glad to come again. I would like to talk about normalization of financial statements.
Okay, message you so I can set another date.
Okay.
Right now.
Okay.
So in the absence of any question, I'll be ending the webinar. Okay, yeah. So just someone does it. Okay, no, it's just a so there's of any questions. So I'll just be like I'll be ending the webinar, but we have another webinar by 4 o'clock. That one is a soft. It's a soft skill session in the Excel community. It's about workplace ethics, and we have another session later by 6 o'clock. That one is going to be about Power Platform and Dynamic 360. So I'll share the link to both sessions so you could register for it. Okay, there's a question, I think. Someone said, hey, Cynthia.
Okay, good afternoon. Please, I just wanted to ask, is there a way we can get the recording of this meeting?
Yes, the record will be available on YouTube. So
On
if you just set YouTube by tomorrow on YouTube. So let
okay,
me
whose YouTube are we following?
UrBizEdge. UrBizEdge
Huh?
YouTube. UrBizEdge.
Okay,
So
I'll set.
I'll post the link here. So
Okay, thank you. I think I've seen it.
Okay.
Thank you very much.
You're welcome. And thank you so much, Daniel. Thank you for this session.
Okay, thank you to Ifeanyi for inviting me. Thank you. I really appreciate the opportunity.
Thank you, Daniel. We're very grateful.
Thank you, Michael.
So I'll be ending the session now.
Okay.
All right, bye.
Okay.